Welcome back, everybody. Today we're going to talk about different types of investments and kind of jump into just the major ones and explore them a little bit. So first things first, this is purely for informational and should not be considered any legal, financial, or tax advice. So please just learn from this and don't consider it any advice. So the question of the day, what types of investments are out there? So stocks, we're going to talk about that. Probably everybody's most familiar with those. Bonds, investment funds, annuities, bank products, and then there are many, many more that we are not going to talk about. This could probably easily be a 3 to 4 hour video just walking through all the different types of investments out there. Even among the 5 that we're going to talk about, there are many different types of those, but we're just going to look at them at a high level and kind of explore them that way. So first things first, stocks. Quite simply, stocks are ownership interest in a company. So when you own a stock, you actually own a piece of that company. So you are a part owner of that company. Typically, it's a very small percentage unless you're very, very wealthy and own a lot of stock in the company. But nonetheless, you are an owner in that company. So there's 2 different ways you can make money. Capital appreciation and dividends. So as the company becomes more valuable, typically the stock price follows that and it becomes more valuable. So as the company does well, so does all of the owners, of which you are one of. And then dividends. So companies will pay out dividends either quarterly, annually, biannually, however the board decides they want to pay it out. And that's essentially the company paying you, paying the owner part of its revenue. So they take that and they'll divide it among all the stocks, and then each stock will get a certain amount. So you get money that way. So how do stocks kind of structurally work? We'll say that you and your brother have a lemonade stand and you are killing it. You are selling so much lemonade that you are making so much money. You're like, I want to make some more money. Because I want to expand, but you don't have enough money by yourself. So what you do is you sell stock in your company. So you take some of that lemonade stand and you sell 5 different stocks. You and your brother keep 1 stock, and then you sell stock to 3 other people, 3 of your friends. So right now you own 1/5 of your lemonade stand, your brother owns 1/5 of your lemonade stand, and then you make money on those 3 stocks that you sold. So then you can take that money that you just made and you can start another lemonade stand and another lemonade stand. And that's how companies kind of raise money, and that's what the companies get out of it, is they get some liquid money that they can expand or do whatever they want with. And typically the people who founded the business also make a lot of money. So that's kind of how stocks work. And then stocks can be bought and sold between people. So if one of your friends wanted to get out, you could buy their stock and then you would own 2/5 of your lemonade stand. So that's basically how stocks work. Next, jumping into bonds. Bonds are a little bit more straightforward on the high level. If you delve into them, bonds can get very complicated. So basically, bonds are debt instruments issued with a set payment rate and maturity date. So there are a couple different types of bonds. So there's treasury bonds, municipal bonds, corporate bonds, and high yield bonds, typically called junk bonds. There are a bunch of other different types of bonds out there, but these are the big ones that we'll talk about real briefly. So jumping back to the definition there. Bonds, a simple way to look at it, bonds are a loan. So you could loan your money to somebody else at a set interest rate. So we'll jump into treasury bonds here. Treasury bonds come from the government. Typically, we'll talk about the U.S. government because we're in the U.S. So the U.S. government gives you bonds. You give the government your money, and then they give you a bond that has a set interest rate. And it will mature. Most bonds mature in about 30 years. And so at 30 years, you'll get your money back and interest on that money. all bonds function somewhat the same way. There's differences in the terms, but we'll just say that all bonds function the same way. So treasury bonds come from the federal government. Municipal bonds can come from your state and local governments. There's different tax benefits to both treasury and municipal bonds. If you guys are super interested in that, I would recommend talking to an accountant because they're the experts. Corporate bonds are the same thing, but with a corporation. So if you wanted to, buy a corporate bond with ABC company, then they would sell it to you, and you would give them your money, and you would get money back at a set interest rate, and then at the maturity date, you would get your what you paid for initially. And then there's high yield bonds. High yield bonds are the same as corporate bonds. The difference between them is that high yield bonds are with companies that are not in great financial shape. So the benefit of those is that they have a much higher interest rate because they are a lot riskier. If you give your money to somebody who has $1 million, they're much more likely to pay you back than if you give your money to somebody who has $100. So that's kind of the thing. And then so to accompany that is they pay a much higher interest rate to make people give them their money. Otherwise, people would just give all their money to more stable companies. We're going to talk about is investment funds. So this is something that people oftentimes get a lot of confusion with around stocks specifically. So what investment funds are the pooling of investor money to create a diverse fund based on a specific strategy. Man, it's so complicated I can't even say it. But so what does that mean? So let's say we have 6 different stocks out there and 6 different companies represented over here. So if you had a lot of money, you could buy stocks in each of those 6 companies. We talked about diversification in another video. If you want to jump back over there and take a look at it, that would probably be helpful towards this conversation. But this is diversification, if you can diversify and spread your money across different companies. So what mutual funds and ETFs do, those are the 2 investment funds we'll talk about, is they take those diversified portfolios, so that's stock in 6 different companies, and they lump it all together into one mutual fund. And then they take that mutual fund and they sell that as a specific stock. So instead of buying stock in 6 different companies, you can just buy this one mutual fund, and it spreads out your investment into a lot of different stocks, usually many more than 6. And so that's the big benefit there. The difference between mutual funds and ETFs, to the casual investor, you can probably treat them the exact same way. There are differences. They're traded a little bit differently, but to the average investor, if you're watching this video, then you can probably think of them as the exact same way. So the thing that sets them apart is that mutual funds and ETFs all diversify the portfolio. Now they're all based on a specific strategy. So the thing that people are commonly into is index funds. So index funds try to track the market or the global market as a whole. So that's their strategy, is they try to have enough of each stock that it follows the trend of the either stock market or global market or even foreign markets, whatever that fund strategy is. And then they do take a fee for it. So mutual funds make money. That's what everybody does. So they take a small fee depending on how much their costs are. So if they're typically tracking a market or a global market, there's not a lot of calculations or manpower that goes into that. So typically their fees are low. But if you have a fund that is tracking a specific area, say healthcare or something like that, then there's a lot more manpower and calculations that go into that. So their fees could be higher. Or if you have a fund that is specifically targeting small cap, so small businesses starting out, that takes a lot of manpower to research all those companies, and they're always changing. So those will probably be some of the higher fees that you see. But yeah, in the end, mutual funds are a quick and easy way that most of us who don't have a lot of money can use to easily diversify our portfolios. So next one we have is annuities. Annuities are an investment that pays out for a specified time. There are countless annuities out there, countless different models. So we're just going to look at the two big ones, immediate and deferred. They're both kind of function the same way. You take a large sum of money, you give it to an annuity company, sometimes a bank, sometimes a specific annuity company, and then that annuity company pays you out for a set amount of time. So it could be a set, 20 years, it could be the rest of your life. There's so many different options out there. It could be for the rest of your life and then the rest of the life of one of your specific dependents. There's many more options than we can count. But the basic model is the same. The difference between an immediate and a deferred annuity: in an immediate annuity, you give the company your money and they start paying you right away. In a deferred annuity, you give the company your money and then they pay you at a specific time, not right away. So it could be at a specific age, it could be after so many years, and the benefit of that is that in that time period your money is growing. So a lot of people will use annuities in retirement because it's a set amount, a guaranteed amount, and you don't have to worry about risk and stock market fluctuations and anything that goes along with that. And then the last things we're going to talk about is probably what everybody is familiar with, bank products. So these are savings accounts, checking accounts, CDs, money markets. We'll kind of breeze through these because I think everybody's familiar with it. So checking and savings accounts, bank accounts that hold your money. You might get interest and is available upon request. This is the most liquid and readily available to you. Anybody can go to their bank and get money out. CDs are certificates of deposit. They hold your money for a set interest rate for a set amount of time. It's kind of similar to a savings account, except you can't get your money out without penalties. So it's kind of like a locked-in savings account, and the interest rate is typically much higher than a savings account. And money markets. So it's similar to savings account, but it pays interest at the variable market rate. So it won't be a set interest rate, it'll be more fluctuating, and typically is very low risk in that as well. So it's kind of a more beneficial savings account, and this is what most of your, if you have cash in an investment account, it will typically be in a money market account. So that's a lot to cover. Hopefully it made sense. Some other videos on the screen for you to consider might be helpful for you, and hopefully this made some of the big investments, different types of investments, helpful to you. Thanks, guys.